Stock Market for Beginners 2023. Investing in the stock market over the long run might aid with money management. When you first start out, putting cash into the stock market may be intimidating since it may seem too complicated or hazardous. You can start with the basics and grow your understanding. The potential for larger returns on your capital and the improvement of your financial management are two of the top reasons to invest in the stock market. For instance, investment in stocks has produced a greater rate of return over the past 10 years when compared to fundamental saving products like fixed deposits. Periodic investments help you develop disciplined financial habits by motivating you to set aside money and invest it sensibly. Here is a quick tutorial to walk you through stock market basics for beginners. Exactly what is the stock market? A stock market is essentially a trading floor where financial items, such as stocks, bonds, and commodities are exchanged. These exchanges not only list firms but also control indexes. The main and biggest stock market in the United Kingdom is the London Stock Exchange, or LSE. London is the actual location of the LSE. The provincial markets, which date back more than 300 years, combined in 1973. Meanwhile, the main index is known as FTSE, is the Financial Times Stock Exchange, or FTSE 100, which includes 100 of the best blue-chip firms listed on the London Stock Exchange. An index is a collection of equities that stands in for a certain subject, such as size or industry. Additionally, it gives investors a way to compare how stocks are trending. Investing stock market basics. You can make direct P2P purchases with cryptocurrency exchanges like Binance, Coinbase, or Kraken, each of which ranks in the top 3. But you cannot do this with the stock market. That means you'll need to choose middlemen, stock brokerages that let you participate using their platform or dealers. These entities are licensed to deal in the stock markets. To get access to these markets, therefore, the first step is to create a trading account, and then you can start investing, letting you view the live markets, place orders, and leverage the trading tools that are integrated into these platforms. Stock market instrument basics. The following are the main financial products traded on the share market. Equity shares. These are provided by businesses and provide investors with the right to receive a stake in any income the business pays out as dividends. Bonds. Governments and corporations sell bonds as collateral for loans that investors provide to the issuer. These have a set rate of interest and terms when they are offered. These are also referred to as debt securities or fixed income securities as a result. Mutual funds, MFs. MFs are a way for financial organizations to aggregate money that is then invested in various financial products. MFs are offered and managed by these institutions. The participants receive a percentage of the investment profits in accordance with the number of units or holdings they own. These instruments are referred to be actively managed since a portfolio manager makes decisions about what to purchase and dispose of on your behalf in order to produce returns that are higher than the benchmark, like the LSE. Exchange-traded funds, ETFs. ETFs are becoming more and more popular. Simply follow an index like the LSE or S&P 500. When you purchase a unit of the ETF, you become the owner of a portion of the stocks that comprise the LSE with the same weighting as the LSE. These items are referred to as passive investments, which are frequently significantly less expensive than MFs and provide you with the same return and risk characteristics as the index. Derivatives. Finally, a derivative gets its value from how well an underlying asset or class of assets performs. For instance, forex pairs, commodities, stocks/bonds, and indices are just a few examples of derivatives. Categorizations. The phrase market cap will appear while you are investigating equities or mutual funds. The worth of the entire firm is known as the market cap or market capitalization. Simply put, if a firm has a market valuation of, let's say, GBP 39 million, that implies you would need that much cash to purchase all of the company's shares. There are 3 different categories of equities based on market capitalization. This is significant since many mutual funds and ETFs are categorized according to the market capitalization they target. Please note that there are different ways to classify the market cap category of a stock, and this is only one basic rubric to give you a sense of things. Buying decisions, stock market basics for beginners. None of the below is financial advice, but is based on research. Set your risk tolerance. The level of risk you can tolerate is referred to as your risk appetite. The time frame for investing, age, aim, and capital are some elements that affect risk appetite. Your current liabilities are another important factor to take into consideration. You will be less likely to take chances, for instance, if you are the only earner in your family. You could have more debt and large-cap stocks in your portfolio at this point. However, if you're younger and single, you can have a high-risk appetite. As a result, you might be able to invest more in shares than debt. You might be able to invest more in small caps, which are riskier companies, even within equities. Making a decision, while bearing in mind that risk and benefit go together, is the first step. Regular investment. Since you now have a trading account, you must set aside money for routine investments. Create a personal budget, keep track of your spending, and calculate how much you can save. Using a systematic investment plan is the greatest strategy to invest in the market. SIP. A SIP is when you make a consistent monthly investment, such as in a mutual fund. This enables you to retain solid investing habits, average out the various market levels you enter, and gradually raise your investments as your confidence grows. Create a diversified portfolio. The fundamental guideline for creating any portfolio is to make investments in a variety of assets. This is due to the fact that it lessens the effects if a particular asset screws up. Diversifying encompasses asset class, sector, and cycle differences. It could be tempting to invest all of your funds in a sector that is seeing growth. However, it is usually preferable to spread investments across industries, balance market exposure/sensitivity, and counteract the risk of equity shares with reliable but lower-yielding bonds. Lastly, ensure you have investments in securities throughout several market cycles by using SIPs. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.